Thank Ant International and World First for the opportunity to be here today and to share some thoughts with you. First, for the opportunity to be here today and to share some thoughts with you. I've been in the forecasting business for almost 30 years now, and there's a couple of things I've learned over that period of time. One thing is that sometimes things are just inevitable. So I think that probably applies to football just as much as it does to the economy. So tomorrow, I think it's inevitable that Spain will play some beautiful football. But it's also easy as a forecaster to overestimate things and to underestimate things. And perhaps if you've been following the tournament throughout, one of the things that has been underestimated is England. Ugly football most of the time. It's not obvious what the tactics are. Certainly some big egos in the team, but they've reached the final for the second consecutive Euros tournament. So don't underestimate them. I'm Irish, by the way. I have no vested interest in England winning. But it reminds me of the EU. The EU is itself an entity, a construct that is easy to, I think, underestimate. It's certainly complex. 28 member states. It's a collection of sovereign nations. That already implies complexity as well as vulnerabilities. And yet, despite everything that has been thrown at the EU in terms of the number of crises over the past 20 years or so, it still exists. It's still going, and that is quite remarkable. So what I want to do over the course of the next 30, 40 minutes is do two things. I'm going to split the presentation into two halves. First of all, to think about the outlook for the European economy over the next couple of years, so the nearer term, but then come back and think about the medium to long-term outlook and to really grapple with this issue of the challenges and the opportunities. Just by way of introduction, I mean, cyclically, when I think about Europe, I think of the direction of travel being positive. Because what's really hit Europe hard over the past few years have been two big negative supply shocks. So that was the pandemic, but also the invasion and the energy shock, the Ukraine invasion and the energy shock that came with it. But those shocks are now unwinding. And so naturally, as they unwind, growth goes up, inflation comes down, and the door opens up to the central banks to be able to reduce interest rates. So that is good for economic growth. It's good for financial markets as well. So sentiment improves really across the board. So cyclically, things are certainly getting better. Structurally, however, I see the EU as being actually fairly challenged. The EU itself was built on trade. It was built on a level playing field, built on the back of multilateral institutions and belief in those institutions. But the world itself is changing. It's becoming less open. It's becoming more frictional. It's becoming more national as opposed to global. And in that world, Europe's competitiveness is declining quite quickly, has declined quite a bit. And that requires a policy response. But I think that is indeed coming. So I will come back and talk about that. Sticking with the cyclical side of things and thinking about growth, we had a tough couple of years, 2022, 2023. We saw broad stagnation in economic activity in Europe. I mean, here's a remarkable statistic for you. The level of GDP growth across the entire continent is probably about 500 billion euros less than what it would have been if we didn't have the shocks, the two shocks, the pandemic shock and the invasion. So that's a lot of lost opportunity. So some businesses feel like we must be in recession. We're not in recession, but we're just a lot lower in terms of the level of activity than we thought we were going to be in 5 years ago. But things are beginning to pick up. So we've been revising up our forecast for growth in 2024, as you'll see in this graphic here. Mostly that is because of international trade. So that's a good thing. Certainly a good thing from a cross-border payment system point of view. We're not seeing domestic demand in Europe recover yet, but our hopes are that as we go through the second half of this year, that will begin to kick in. Central banks are on the verge of cutting interest rates. If they're not already cutting interest rates, that will help. That will help investment spending, and that will help consumption as well. So trend economic growth in Europe, the average over time, is about 1 to 1.25, so it's in this region here. So this year we're getting close to it now. That's encouraging. Next year we're going to be a little bit above it. Inflation, I can remember for many years not really talking about inflation, but it's come back to bite us recently. Inflation reached, certainly on the continent, it reached 10.6% about 18 months ago. The highest for 40 years. It really was quite incredible. Central banks, unfortunately, didn't see it coming. Inflation is down a lot. It's down to about 2.4%, so it's now rounding to the central bank target. So we have come a long way. Within the details, because these inflation metrics, they're made up of goods prices and services prices. Goods price inflation is essentially zero now, so that's nice. But service price inflation is still running at about 4% and has been quite sticky at that level since the start of this year. But we are optimistic that inflation will continue to fall. It will fall back towards the central bank targets over the course of the next 12 to 18 months. A lot of the optimism comes from the labor market. You guys are employers, I'm guessing, and wages have been going up quite a bit in the last couple of years. We've all struggled to find staff, right? But we are beginning to see indications that wage inflation is topping out. The labor market in general is beginning to rebalance. So vacancies are coming down. That's good news. Shortages are beginning to ease. That is good news as well. So the inflation picture, I think, is generally improving. And that feeds into the outlook for monetary policy, or what central banks are doing. Central banks raised interest rates the most in 40 years as well. Inflation increased the most in 40 years, and central bank policy rates went up by the most as well. Central banks are also beginning to reduce the size of their balance sheets. So you may have heard of QE. Money printing is the nice way of simply describing what QE is. We're now in a world of QT, so quantitative easing becomes quantitative tightening. Money printing becomes money burning. Imagine that, central banks just burning piles of cash. That is essentially what they are doing. So monetary policy had tightened, but we've reached the point where interest rates are starting to fall, whether on the continent, in the UK, in America as well. This is becoming a global phenomenon, and I think that will continue over the course of the next couple of years. So cyclically, growth is going up, inflation coming down, central banks will be reducing the cost of financing. All good. Structurally, however, I am troubled, and the thing that troubles me the most is competitiveness in Europe. The dark blue line in this chart here is a measure of European competitiveness. We had two negative shocks over the last 5 years, which is the pandemic and then the invasion and the energy price shock that we suffered. What really concerns me now is that gas prices in Europe, which went from about 30 euros per megawatt hour to 300 euros per megawatt hour in the context of the invasion, that's gone back to where it was pre-invasion. But despite the fact that the price of gas has gone back to where it was, competitiveness remains at all-time lows. So I think there's lots of things going on behind the scenes here. I think you've got concerns about energy security still within Europe. I think you've got questions about US industrial subsidies. Certainly in a country like this, Germany, where the auto sector is quite considerable, there's also questions about the competitiveness of Chinese EVs. They're very competitive. You see a lot more of them around now. But it's more than just that. It's questions about supply chains. It's questions about access to skilled labor. It's questions about the cost of the green transition. So at lots of different levels, there are questions about competitiveness in Europe. Now, Europe, I think what competitiveness kind of gives us some insight into, and the lack of competitiveness gives us some insight into, is the fact that Europe has developed on the back of this very open trade-based model. And that has led to the development of what I would call excessive external dependencies. And perhaps the simplistic way of describing this, and it's a very easy and simple way of describing it is, but Europe became dependent on Russia for gas, it became dependent on the US for defense, and became dependent on exports for all of its growth. And those issues are now beginning to come back. They're coming back home to roost, and that's where the competitiveness issue is becoming a problem for Europe. I mean, this is fascinating. This chart, which goes from 2003 up to the present, and shows you what we call openness to trade. So it is the sum of exports and imports within the economy as a percentage of GDP. And you get this very, well, I mean, it's noisy, but you get a very clear sense of the trend over time, which is upwards. Trade is really very important to the European economy, and more so over time. Right? Now, the authorities are aware that there is an issue here, and what Europe has been talking about as a potential policy response to this is something called open strategic autonomy. We love phrases and acronyms in Europe. It's not exactly the most transparent. What does open strategic autonomy actually mean? What it means is Europe wants to be able to trade. It wants to be able to maintain and build alliances. But at the same time, it wants to preserve its independence and be independent in terms of energy supply, security and defense, technology, supply chains, labor, finance. But while this all sounds great, it's not actually a detailed plan. It's a talking point. That's all it is. It's not a detailed plan. It's not costed. It's not funded. We've just had the European parliamentary elections. There's a new commission coming in. We know what their strategic objectives are going to be, and those strategic objectives are going to be competitiveness, thankfully, security and defense, EU enlargement, and the financing of all of these. So we are going to hear an awful lot more about this topic going forward. The difficulty within Europe is that politics has become increasingly challenging. Now, 2024 is a really interesting year because half of the world's population live in countries that are holding elections this year. And I think that's the first time this has ever occurred. And there are some big elections, even outside of Europe, that are going to be quite relevant to Europe. So if we take the US presidential election in November, it should be binary in the sense of it should be a choice between Biden and Trump, or I should put an asterisk beside Biden. AN other, perhaps. Keep watching this space. But the concern is if Donald Trump was re-elected for a second administration. We had trade war under the first Donald Trump administration. There may be additional frictions in terms of geopolitics as well, given the questions he's asked about US involvement in Ukraine, US involvement also in NATO. So we're going to be watching this US election very, very carefully because that gives us a sense of just how much of a deficit open strategic autonomy is, how far we're going to have to go as a bloc of united countries to achieve open strategic autonomy. The recent European parliamentary elections, and this shows you a very colourful outcome of the European parliamentary elections across all the member states, this helps us understand the extent to which Europe can actually bridge that gap, the extent to which we can actually fill that deficit, that open strategic autonomy deficit. And these elections, they were important. They showed that the far right in Europe is getting stronger and stronger. 22% of the vote went to the far right. So the middle ground, the mainstream parties, the traditional pro-European parties, they are suffering. Their support base is getting narrower and narrower. They still have a majority, but life is getting more and more difficult for them. We had another election recently as well, which is the French election. We had kind of two surprises to come out of the European parliamentary elections. First of all, Emmanuel Macron, the French president, decided that he didn't like the results, so he was going to call his own French parliamentary election. No one saw that coming. But the second surprise, because everyone assumed that Marine Le Pen's right-wing party, the National Rally, was going to win, the surprise result was it was the far left who won, not the far right, ultimately, who won. Now, it was because the far right, over the course of the election campaign, lost quite a bit of support relative to where they had actually been. But this is a situation we need to keep a close eye on, because France is fiscally vulnerable. It is one of the more fiscally vulnerable countries in Europe. And what we've learned time and time again across Europe over the past 10 to 15 years is the populists, when they come to power, they promise you things. There's a lot of have your cake and eat it. But the reality is, at the end of the day, as you guys understand, you run businesses, you have to balance your books. The money has to come from somewhere. And the money for these countries who run deficits comes from the rest of the world. It comes from the international bond market. And the international bond market called out Greece a decade ago, it called out Italy in 2018, it called out the UK in 2022 when we had the Liz Truss moment. So these situations need to be followed quite carefully. There is a potential for this to cause more stress within economies. And macro vulnerability, I've talked about France. So what we have in this chart here is the fiscal debt. If it's a negative number, it's a fiscal deficit, percentage of GDP. And this is public debt as a percentage of GDP. So France is one of the European countries with a very high deficit level. It's also a country with a very high debt level. But France is not unique. It's a spectrum. There are other countries that are in a broadly similar position. So the challenge in Europe to balance the books, the challenge in Europe to be able to give something back to the people, because the people are not happy. Right? What static growth and stagnation over the past couple of years tells us is that economic well-being is not growing. And we had that challenge after the global financial crisis. We had it again with the pandemic. We have it again with the energy crisis within Europe. So there is pressure to be able to give something back to the people. But where does the money come from? Ultimately, this creates challenges. And that takes me into the second half of the presentation. So a bit of a downer at the end of the first half. So let me try and talk things up in the second half of the presentation. There was a gentleman by the name of Jean Monnet who came out with a really fabulous quote. He was one of the founding fathers of the EU. And he came out with a fabulous quote about 60 years ago. He said that the EU would be forged in crisis and would be the sum of the responses to those crises. And it's still relevant today, because you have to think of the EU as being a work in progress. Even though it has been around for 60 or 70 years, it is still a work in progress. And each crisis that comes along is an opportunity for Europe to work on itself, to make itself stronger. And we've seen this occur time and time again. So what I want to do in the second half is do two things. I want to think about some of the areas where Europe needs to focus to make itself stronger, more sustainable for the future. And then I want to draw attention to a few things which I would consider to be assets, even if just latent assets, things on which a brighter future can actually be built. So the first one is a defense union. Now I know this is going to be difficult for Europe because constitutionally some European member states have neutrality embedded into their constitutions. So this mightn't be a fully effective union, but Europe took its security for granted, and the invasion of Ukraine burst that particular bubble. But in terms of defense spending, Europe has been underspending for a long time. If you take the NATO defense spending target, it's 2% of GDP, but Europe has been underspending against that on average for a very long time. So there's been underspending, there has been free riding on the US, there has been wasteful spending as well. There's no common procurement of defense assets. We end up with lots of competing defense systems. There's no interoperability between the various defense assets that exist across the member states of the EU. All of this is problematic. So Europe needs to raise its defense spending. There's no doubt about that. With or without Donald Trump, that is going to have to happen. But the defense spending is going to have to become more efficient as well, more joined up, more common, create that interoperability. From an economic point of view, there is potential upside in this. Because what Europe is going to have to do as well is develop an onshore defense production industry. At the moment, 70 to 80% of all military spending goes offshore. A lot of it goes to the US. So a lot of that has to now come from inside Europe. But the second potential economic positive is that, and you'll observe this in the Ukraine, war and warfare is now high tech. And that has the potential to spill over in terms of technology benefits to an economy more broadly. So this is interesting. An energy union. When I think back to the global financial crisis, that was a really interesting event for the world because it really opened everyone's eyes to the fact that there is a financial counterpart to every economic activity. You kind of take the flow of money for granted. And I guess one thing that World First would like to is just help that flow of money, right? But we took the flow of money for granted, but when the money stopped flowing in the context of the global financial crisis, economic activity stopped as well, naturally. But the shock on the energy side after the invasion of the Ukraine equally opened everyone's eyes to the fact that every economic activity has an energy counterpart. And when your energy supply is put in doubt, guess what happens? Economic activity gets put in doubt as well. And it reminded me of the situation, actually, Europe enjoyed between the 1950s and the 1980s. Europe discovered oil and gas in the North Sea. And when it discovered that plentiful supply of cheap energy, growth converged between Europe and the US. Since then, it's kind of diverged. And energy has been a key part of that. But there is a potential upside here. Europe has spent a lot of money in different ways across its various member states on renewables. So Germany has a huge wind industry. Spain has a huge solar industry. France traditionally has had a very strong nuclear industry. But they're not joined up. There isn't actually a unified grid in Europe. And if that is resolved, that could unleash some upside. This needs to be addressed, if for no other reason than AI is part of our world. And for AI to be an important part of our world, we need data centers, and data centers need energy, right? So this has to be addressed. The third union I'm going to mention is capital markets union. Now, technically, legally, theoretically at least, capital is free to flow around Europe. But how easy is it to actually get funds to flow around Europe? And this is where World First comes in with some solutions, which are really quite interesting. One of the things that politically Europe is very focused on right now is something called capital markets union. We don't have a unified capital market in Europe. The fact that we don't actually, or we do within Germany, between the states within Germany, but we're not like the US, we're not even like Canada, and that gives us much less buffer to absorb crises. So in a world where funding is tight, public balance sheets are enlarged, governments don't want to spend a lot of public resources, one way of potentially freeing up resources for the big investment needs in Europe, like the green transition, the digital transition, strategic autonomy, is to finally deliver on a capital markets union, to tap into these local pools of savings that exist in Europe. Overnight deposits in Europe, in aggregate across the banking systems, are equivalent to 8 trillion euros. Overnight deposits. Does it all need to be sitting in an overnight deposit account? Even a small fraction of that, if it was freed up to move into something with a bit more risk, a bit more duration, could make a big difference in terms of funding risk appetites within Europe, technology within Europe, and enhancement of productivity within Europe. So don't underestimate this. I think it's a very interesting issue in and of itself. So 3 unions to think about. But then three assets to think about as well. And the first asset I want to mention is the single market. Exports are important to Europe. I mentioned that already. So EU exports are 15% of global exports, which is roughly equivalent to China's portion of global exports and the US portion of global exports. But what Europe has as well is this single market, the internal market. And for some countries, the internal market is a lot more important than the external export market. And membership, it's estimated that membership of the single market is worth as much as 10% of GDP to the member states of the EU. So it is a remarkable thing. But it's not complete yet. Services, for example, only 20% of services actually move across borders. Now, not all services will be able to move across borders, haircuts, for example, but business services, financial services, legal services, design, all of these things, there's a lot more scope for these to be able to move across borders and create growth and wealth as it happens. A second positive that I'll mention is economic complexity. And I mean economic complexity from a positive perspective as opposed to a negative perspective. There's something called the Economic Complexity Index, the ECI, and it captures the accumulated knowledge and know-how of an economy. So as it evolves over time, it builds a knowledge base. And what we find is that over time, there is a strong positive correlation between a country's economic complexity index and its economic wealth or its growth. So this is very important to economic development. Now in Europe, if I think about the last 20 years, there's actually been a decline in the number of EU member states in the top 10 most economically complex countries in the world. So what you'd find in 2020 is a lot more Asian countries, for example, understandably. But, and this is important to understand, actually the average ECI or ranking of a country in Europe over this period of time has actually been going up. So we've been getting more technically sophisticated over time. There's just fewer European countries in the top 10. Europe actually has very good fundamental science. There's a lot of R&D that does take place in Europe. And if you look at citations of scientific papers, which is one way of judging the effectiveness of your fundamental science, and if you sum those citations up across the European member states, it's broadly equivalent to the US. So you're getting as good science here as in the US. What you're not getting here is the commercialization of science. That's what's missing in Europe. And this is down to things like funding for risk activities. So patient capital, for example, within the tech sector. It's down to bureaucracy, red tape. And it's down to rules and regulations within the single market that go against the ability to scale up. But these are things that are fundamentally fixable. And what's interesting and encouraging is Europe is beginning to think about these things finally. Right? So we are going very much in the right direction. The final issue as a positive is the resilience of the European economy. So I mentioned earlier that GDP stagnated in 2022 and 2023. And obviously stagnation, certainly stagnation over that period of time, an 18-month stagnation, it sounds like a real negative. The reality, however, was that actually I felt like that was a real outperformance. What we should have had was a recession, maybe two recessions, maybe two deep recessions, because of the scale of the energy shock that Europe suffered, but also because of the scale of the tightening of monetary policy that we had from central banks. But we stagnated. We didn't recede. So there was resilience within the economy. So why was there resilience? Well, there's two things that are normally associated as recession amplifiers so they normally amplify a shock when it occurs, a negative shock when it occurs, that actually turned out to be recession dampeners over the past couple of years. So this was good news for Europe. And one of them was the labor market. So this is the unemployment rate for the euro area. You can see the global financial crisis. Actually, we had two back-to-back crises. We had the global financial crisis and then the euro sovereign debt crisis. But over that dual crisis 10, 15 years ago, the unemployment rate in Europe went from, let's say, 7% to 12%. That was a lot of people, millions and millions of people lost their jobs. Then fast forward, we had the pandemic in which GDP fell 25%, which is nuts at the time. There was an increase in unemployment, but it was a very modest increase and it didn't actually last for very long. We then had a second shock, and I know what you're going to say to me, there was no shock, because unemployment didn't actually go up. So this is really curious. It's one of the conundrums in the macro space at the moment. Why is our labor market as strong as this? Now, there are different explanations. There were labor shortages in the pandemic. People couldn't work, so there were skills shortages. So businesses were afraid to fire people in case they didn't get back the valuable skills that they would be losing by firing people. So that might have been part of it, just an issue associated with the pandemic itself. But it might also be related to the aging of populations in Europe. We've reached the point where population is in decline. And that creates its own skills shortages over time. And that might be contributing to the reluctance of firms to shed labor. But when people are employed, they are able to spend. They have the confidence to spend, right? So this adds a lot of stability to the economy in general, contributing to that ability to avoid recession in the last couple of years. The other positive, which can quite often be a negative, is private sector balance sheets. Household balance sheets, corporate balance sheets. We had a balance sheet problem 15 years ago. There was excessive debt in Europe. That debt needed to be worked off. And we ended up in what economists call a balance sheet recession for several years. They tend to be long-lasting and quite deep. But I think we enjoyed a legacy benefit from the fact that the last downturn was a balance sheet recession, because it meant that we were going into this shock, or these shocks, with actually quite lean balance sheets. We didn't have as much debt on our balance sheets. And if we didn't have as much debt, it was easier to maintain businesses in general. It was easier to maintain employment levels in general. So it's interesting how it's worked out over the past couple of years. You might look at stagnation as being a pretty poor performance, but I look at it as being actually quite a resilient performance at the same time. But there's another aspect to resilience that I'd like to mention, if you can humor me for a moment, because really this is a story about the wisdom of economists. I think Europe has actually implemented some pretty smart policy over the past few years. The way that Europe responded to the pandemic itself was, to me, quite inspired. So you had these furlough schemes, these schemes that allowed firms to hold on to their labor for longer periods of time, funded by governments. So that maintained firm-specific human capital. So that was useful at the time. We also had some very smart banking policies, subsidies to the banking system, which allowed banks to continue to lend at a very difficult time. The fear in March 2020 was that we could end up with a credit crunch like we did after the collapse of Lehman Brothers. But we had a very smart, rapid response to completely avoid that outcome. So that was smart. And the third smart element of policy making was something called NGEU, Next Generation EU, which is this 800 billion euro facility to secure the recovery post-pandemic. Now we got it very quickly, within 6 months of the start of the pandemic. To took a long time to construct it even after that, but there was an agreement on this quite quickly at the start of the pandemic. But it's more than just a recovery fund. It's more than just supporting the economies as they get back on their feet. It was an attempt to future-proof Europe, because more than 50% of the 800 billion is being poured into the digital transition and the green transition. So I think Europe is capable of doing smart things. If you put Europe's back against the wall, even in very significant crises, it is capable of standing up and delivering. So to bring this to a conclusion, cyclically, maybe I should move on to this final slide. So cyclically positive, as I mentioned, the shocks are dissipating, so that's good for growth, should bring inflation down, allow central banks to cut interest rates. Structurally, Europe is more challenged. There's more that needs to be done in terms of policy making. Hopefully, open strategic autonomy becomes more than just a talking point. But I'll just reiterate some of the positives. The resilience of Europe, smart policy making, and these inherent assets, things like the single market, an educated workforce, fundamental science. So there are people who like to beat up on Europe. And for sure, I mean, Europe is a mature economy. It's not going to grow very quickly, right? It's going to struggle to grow very quickly. But it can grow. And it can grow more than it is at the moment if we give it the right kind of policy support. Thank you very much. Thank you.